In this video, we're going to be talking about the most common mistakes I see people repeat over and over again when it comes to trading. I have taught hundreds and hundreds of different traders, and these are the top mistakes I see people repeat over and over again and how we fix it. So, starting off, price reversal near points of interest. Now, what I mean by that is when price gets very close to a point of interest, which could be a high or a low or a higher time frame inefficiency, there's one mistake that I see traders make over and over again. So let's quickly go over exactly what that mistake is. So in this example right here, we have a large point of interest, which is a 12-hour imbalance, inefficiency, or fair value gap. Again, you guys should know by now, the market is attracted to two different things, that being imbalances, inefficiencies, fair value gaps, whatever you want to call it, and liquidity. In this example, we have a higher time frame imbalance that we have not hit yet, and we have equal highs. That means we have large inefficiency and we have a bunch of stop orders, and I would therefore classify this as a large point of interest. So when the market gets that close to such a large point of interest and then starts pulling back, this is where a lot of people mess up. What they'll do is they'll likely long the first imbalance or PD rate that they see simply because they are expecting the large point of interest to be hit. Now, throughout the years, I have noticed certain things in markets that reverse very close to the large point of interest, and that is it is likely going to equilibrium of the range or 50% of the range before hitting your point of interest if it reverses very, very near it. So all the people who are going to long here, because again, they're expecting the point of interest to be hit and they're therefore going to anticipate that the bullish PD arrays and imbalances is going to hold, they are likely going to get stopped out because again, about 80 or 90% of the time, we are going to retrace down to 50% of the range and then a rally into the point of interest. So if I play it out here, we can see exactly that happening. And right there it was. Again, we came down, we hung around equilibrium of the range for a little bit, and then we skyrocketed towards our point of interest. So through experience, I have noticed that, okay, whenever an asset is very, very near a point of interest and then starts to reverse, I can anticipate that asset to go to 50% of the recent range and then the large point of interest. So I am not going to look for a long until we have hit 50% of the range. And that is exactly what I mean by newer traders or traders in general making mistakes when the market reverses very, very close to a point of interest. Now, the second one, and arguably one of the most important technicals, understanding premium and discount. I simply do not see enough people utilizing premium and discount and also equilibrium. I am fully aware that the majority of people understand what it is and how to use it. They simply just don't use it enough. Premium and discount is how the market moves. It moves from discount to premium to discount to premium. It is therefore essential that you completely understand exactly how to use it and when to use it. So for example, this is a chart of the E-mini S&P 500, and as you can see, we are inside of a very downtrending market. Now right here, price started to reverse or at least give a pullback in this downtrending market. Now, how would I possibly know where this pullback might end? Well, the only way for me to tell when this pullback is going to end is by utilizing premium and discount zones. Because again, right now, price is trading in a discount zone. And when we get a pullback in a downtrending market, the highest point I would expect it to go is a tap into premium and then back into discount. Because again, market moves from discount to premium to discount to premium. So the easiest way to tell when a pullback is going to top is by utilizing premium and discount zones. So let's see exactly what happens with this pullback here. And as you can see, price barely tapped premium and then it continued the beautiful downtrend. And the only reason why I knew that the pullback may end right here is again because I understand how premium and discount works. Now, premium and discount is not only relevant to figure out when a pullback is going to end, it is also very, very useful on an intraday basis. So for example, right here, we are on Euro USD on a 5-minute chart. And in this leg right here, we have 3 fair value gaps. Now, if I wanted to enter off of any of these 3 fair value gaps, how could I possibly know which one of the 3 I should trust? Well, the easiest way to figure that out is by utilizing the premium and discount. So I want to take the fair value gap that overlaps with equilibrium of the range. Because again, this is a market I am expecting to go higher. So the pullback should ideally end at around 50% of the newly created range, which is exactly why I'm going to trust the fair value gap that is near equilibrium, because that is the lowest point I am expecting price to go. So let's see exactly what happens right here if I play it out. And as you can see, that imbalance ended up holding beautifully. We just barely tapped discount and then we rallied towards this high. So if I didn't know how premium and discount worked, I would have no idea whether I should use this one, or this one. But because I understand that if I am expecting this market to go higher, the absolute lowest I would expect it to go is again going to be a tap into discount and then a rally into premium once again. Now, the third way that I really like using premium and discount is to figure out where price is going after hitting a point of interest. So right here, I have marked out this hourly imbalance. And as you can see, we have just swept the lows that are inside this hourly imbalance. So a lot of people may expect higher prices from here, and they would probably be correct. But how do you know how far up price is going to go based off of the 1 hour fair value gap reaction? Well, the easiest way to figure out where it's going to go is by utilizing premium and discount. So again, we've just hit a higher time frame point of interest. I'm expecting a pullback, and I'm going to expect that pullback to end at around equilibrium of the range. So let's see exactly what happens. And as you can see, we hit the hourly imbalance, we got the pullback, that ended at around 50% of the range. We then drop back lower, we start to see a pullback again. Now let's quickly take a look at where that pullback ended. Boom, right at around equilibrium. This pullback ended as well, and then we continued to the downside. So these are the three ways that I enjoy using premium and discount, and I do believe a lot of people would be way more successful if they started implementing this in their day-to-day trading. Again, this is how the market moves, so understanding exactly how and when to use premium and discount and equilibrium is essential. Another mistake I see a lot of people make is their stop loss placement. You see, a lot of traders will try to have as small of a stop loss as possible. Now, while that looks great on social media and it's going to give you a high risk to reward, it is often not the best idea. The reason for that is because the tighter you make your stop, the harder you make it for yourself. It's irrational to think that you as a trader can predict the market reversal down to the tick, which is why I think the majority of people should not be having a tight stop loss. They should allow their trades to breathe. They should allow their trades to go in drawdown before continuing in whatever direction it is that they wanted. Because again, if you can get the direction right and your stop loss is large enough, you are going to win the majority of the time. The problem is when you have a very tight stop loss, your idea could be correct, your bias could be correct, but you could still get stopped out simply because you didn't allow the market to breathe. So my advice for a lot of traders is to make their stop loss a lot larger, even though it may not look as cool, it may not look as good on social media. I personally believe that that will help you become a much, much better trader. In my opinion, it's not super important where you place your stop. The most important part is understanding why you place your stop there. So my analogy when it comes to stop loss placement is that you want to place it in a place where if the price goes there, your idea is invalidated. So again, let's use this right here as an example. Let's say I wanted to enter off of this 15-minute imbalance right here. My stop loss could go to this swing low right here, and my target could be a 1 to 2 risk to reward. Now, the reason why I'm placing my stop here is because I am entering this trade based off of this imbalance. If price ends up coming all the way down here and sweeps this internal low, well, then this imbalance was invalidated. And if the imbalance is invalidated, that means my idea was invalidated. So I understand exactly why I'm placing my stop here, because again, I'm going into this position with the idea that this imbalance is going to send price higher. I am therefore going to place my stop in an area where I can tell myself, okay, if we go here, that imbalance obviously did not hold and my idea is invalidated. And that is exactly how you should be treating your stop losses, in my opinion. Don't worry about how good it looks. Don't tighten it too much. Give the market a chance to breathe, and I guarantee you, you will see way more success. Now, let's talk about risk to reward systems. This is a very controversial topic. I am a firm believer in a lower risk to reward system, especially for prop firm traders. My general advice for intraday traders is going to be a 1-to-1 risk to reward. Again, because with the rules of the prop firms and the trailing drawdown and even the unrealized trailing drawdown, the easiest way to combat that is to have as high of a win rate as possible. And the easiest way to get a high win rate is to have a lower risk to reward system. So because our stop loss is trailing, we want to lose as little as possible. And the easiest way to lose as little as possible is to aim for a 1-to-1 risk to reward. Again, anything above a 50% win rate will make you profitable at a 1-to-1 risk to reward. And if I were to ask you, can you have above a 50% win rate if you are trading a 1-to-1 system? The majority of you would probably answer yes. So then it does not really matter. That is exactly why I want the majority of you guys to trade a very low risk to reward system, again, because you want to have as high of a win rate as possible. And that is the easiest way to exploit prop firms, in my opinion. Now, on a personal account, this can be very different. We don't have the same rules when it comes to trading with a regulated broker. So if you are on a personal account, you can obviously do whatever you want, but I know the majority of you guys are trading prop firms, which is why I recommend a 1-to-1 trading system and a maximum of a 1-to-2. The biggest reason why people do not want to run a 1-to-1 system is simply because of their ego. When you're trading a 1-to-1 system, it doesn't look as great as running a 1-to-10 system. But again, you guys should not care about what other people think. This is, again, something I'm going to be talking about in a few minutes. So having the right risk to reward approach is, in my opinion, key, and especially when it comes to prop firm trading. And again, one of the biggest mistakes I see people make over and over again is having way too high risk to reward trades. People are aiming for a 1-to-8, a 1-to-10, a 1-to-20 because that's what they see on social media. So again, my advice is going to be aim for a low risk to reward system so that you can have a high win rate and avoid the trailing drawdown. The last one, and arguably the most important one, is social media influence. Now, what I mean by that is a lot of people have the complete wrong idea and approach to trading simply because of social media. Just like we talked about, a 1-to-1 risk to reward system is generally not viewed as a good thing on social media, but that's the furthest from the truth. This is a subjective industry. What works for somebody may not work for somebody else, which is why it's super important that you do not get stuck up in other people's analysis and thoughts on social media. For example, I see a lot of students coming from a red day, jumping on social media and seeing a lot of people having green days. They then start to question themselves. What did I do wrong? They start to question their system, which will make them break their system. And it's just an evil spiral of things that should not happen. The reality of it is, when you are coming off of a red day, that means somebody else won. And when they are coming off of a red day, that means somebody else won. Again, somebody has to lose in order for somebody to win. So whenever you're looking at somebody and saying, dang it, he made money today and I didn't, there are also days where you made money and he didn't. The only difference is this guy only posts on social media when he wins, so it looks like he's winning all the time, but that's simply not the truth. It's also very important that you limit the amount of information that you're getting and you limit the amount of people you're getting the information from. Because again, like I've said hundreds of times on the YouTube channel, trading is the most subjective industry. So you could have 1,000 different educators with 1,000 different answers, which is why it's very, very important that you are very picky about who you choose to learn from. And when you've chosen a few people to learn from, I want you to only learn from those people. Because while I may say something and I may spend my time trying to teach you how to do this one thing, tomorrow you could jump on another guy's YouTube channel and he could say something completely different about the same concept. Both of us could be correct, but we have a different way of teaching it, which is why it's important that you listen to 1 or 2 people at a maximum. So thank you a lot for watching this video, guys. This was just a rant about a lot of mistakes that I see traders repeat over and over again. So hopefully you learned a thing or two, and maybe you were even making some of these mistakes yourself. Now, after watching this video, you are hopefully not going to do that anymore. But without further ado, thank you a lot for watching, and I'll see you in my next video.